Hey everyone, it's Nick with Us versus Her. Today we're going to be going over the break-even price that is displayed in Robinhood. I get asked this all the time and there's a lot of confusion about it, so I figured, hey, let's make a video. I'm going to give you a couple examples on both the call side and the put side and how to do the math. So let's dive right into it right now. I'm looking at Apple right here, and I have the calls up. I'll also do the puts. Now, the thing that you're gonna have to understand, so right here, they highlight the break-even price, and for most people, especially trading on a Robinhood, the break-even price doesn't make a lot of sense. The break-even price is there if you are assigned the shares, right? So if you're just trading the options, the break-even price is irrelevant. So if you are assigned the stock, so you're assigned the shares, because one options contract equals 100 shares. So let's say you bought an in-the-money call, right? Let's say you bought this 137 call and it went up, you wanted to get assigned, you would actually, your break-even price would be $138.36 if you were assigned only, right? And that's how you add it, right? So how did they get that price? They took the price of the option right here and the strike price, and they added together. So if we're looking, let me highlight this for you right in here. So 137 plus $1.37 equals 138.36, and we can pull it up on here just so you can kind of understand where you're at. So 137 plus $1.36. So if you're assigned the stock, the shares, so if you bought the option and you wanted to exercise it, you want to own the shares, if you own 100 shares, your break-even price would be 138.36 of the stock. So Apple would need to be $138.36 for you to break even on the stock, not on the options, not on the options contract, okay? It does not pertain to the options contract. And people go, why would they put that in there? It's because it's mostly for premium selling, or if you want to exercise the shares, or you get assigned the shares if you are premium selling. Now, if you are just trading the options, you don't need it to go up to this break-even price to make money, right? Because right now, I mean, you could buy any of these. If the stock goes up a little bit, you'll be making money. And how do you determine that? So let's look at this 138 call right here. 138 call, you're going to be looking at mostly like the delta. And if you don't know what delta is, I definitely encourage you to, get familiar if you're trading options. If you don't know what delta is, you're gonna have a very, very rough time. But delta is going to tell you. So on this contract, so this is the 138 call. Delta's at 42 cents. So it's saying for every dollar that this stock goes up, the delta or the price of your options contract is going to go up by 42 cents. So right now, if it goes up a dollar, this is 86 cents. You can see right in here, highlight this for you. Price of this is 86 cents or 90 cents as we're talking. So if this goes up, your options contract is going to go up 42 cents if it goes up by $1. And that's kind of how you determine if you're going to be making money or losing money. Also, if it goes down $1, you can also determine it that way. So let's do 88 cents plus 42 cents. So if it goes up $1, so right now the share price is $1.3747. So if it goes up to $1.3840, $1.3840 and some change, it's going to be that the options contract is going to be $1.30. Now there's more at play, especially if you're holding overnight. These actually expire tomorrow, where theta is going to start eating into that. But I don't want to complicate this video too much. I have a lot of other videos that explain, the Greeks and all that. But if you're looking at it, this is how much it would be, not including theta or anything like that. It would go up. This contract would go from 90 cents to basically $1.30. With a 43 cent delta, right? So let me give you another example here. If this goes down, okay, so if it goes down, so if right now we're 92 cents, so if it goes down, let's do 92 cents. If it goes down $1, you're gonna be at 48 cents. So if it goes down $1, it's gonna be cut in half. Also, it's gonna be probably cut down more than that. So if you're looking at the break-even price, you're like, hey, why am I not profitable even though it's at the break-even price? Why am I down money? You know, there's a lot of other factors such as delta, theta, or gamma. Now let's go over to the put side. So we'll look at the put side here. We'll look at the same this same put right here, and it works the exact same way. So we're going to be looking at the, let's say 138. How do they get the 136? How do they get the 136.60? Well, basically they took 138, then they subtracted the options price was $1.38. Remember, this is a put, so you're gonna want to subtract. And you're gonna have a call, you want to add. So we're gonna subtract it. It's got 136.62. So about right. These price. I mean, the market's live right now, so these prices are changing here. So 136.62 is how you get the break-even price. Now again, these are only the break-even price if you have these shares. You want to be concentrating on, again, let's look at the delta. And you'll want to definitely learn theta, but I don't want to complicate it too much for you guys. I just want to kind of run through the different scenarios here on how you would determine the price if it went up or down from where you bought it. So right now the share price is 137.56. If this is at 56 delta, so you would subtract the 56 from the $1.38 to get your, or to add a $1.30. Sorry, 56 cents. You would add it to the $1.38, $1.37 here if the share price went down. So $1.36, plus 55 cents. This would be $1.91. So this would go from $1.34 to $1.91 if the share price went up $1. Again, delta measures the price change if the share price moves $1. So if you do it, you can split it any way you want. If this goes up 25 cents, delta will be the same. If it goes up 50 cents, cut this in half, you get the idea. I mean, if you're trading options, you should be able to do simple addition like this and try to figure out what a quarter is, what 50 cents is. If this goes up 25 cents, I'm just giving you the full dollar right now. But that's essentially how you do it. Same thing. Let's go to AMD. I mean, this works for any. This is for any stock. Again, here we're looking at. Let's look at the 82. The 82. We'll go to the 82. Yeah, we're at the 82 call right here. Okay. So the 82 call. Let's look at here. Strike price 82. Break even 82.98. And how did they get that? They took 98 cents plus the strike price. They got 82.98. And that's your break-even price if you own 100 shares. If you get assigned this stock, long or short. For a call, you'll be long. For a short, for a put, you'll be short the stock. Okay, if you're assigned shares. So again, if you, I'm not going to go through the whole thing because I think you guys got it. But that's essentially how you determine the break-even price. Is it's only for if you're assigned the shares. If you have those shares in your account, those 100 shares per contract that you have. And you want to exercise those, or you get assigned those if you're short the premium. But essentially, you don't need it to come up to the break-even price to make money. So I just want to be clear on that. Make sure everybody understands. If you have questions, leave them in the comments. As always, stay safe, stay green. It's us versus herd.